TheoTrade. This is Don Kaufman. It's March 3rd, 2023. Just about 20 minutes left inside of this trading week here on a Friday afternoon. Why is 0DTE changing the face of markets? That is this weekend's topic of conversation. Obviously, this has been the topic of conversation in the entire trading community. Only 2 weeks ago, we kind of dedicated one of the weekend updates to it. We're going to be discussing it again because there is a very key area that we've picked up on that I'm telling you, pay attention to this weekend's update. It is driving market movement now on a day-to-day basis. And I'm actually going to explain how and why it's actually driving the momentum of markets, both higher and lower. The other thing that we're going to cover is why we've actually seen so many kind of wicked reversals in the marketplace as of late. It's a critical area of the market. If you're not familiar with 0DTE, basically, it's trading options that are going to expire today. Now, it's the here and now. And understanding 0DTE doesn't necessarily mean you have to trade it. But I'm going to tell you right now, this marketplace, its memory is like 7 seconds, and that is it. And I'm going to explain exactly what that means. First and foremost, though, let's just talk about the markets for a moment in general. All right, first thing up, we have hit the upper edge of the expected move here on this Friday afternoon. And we talked about this expressly, okay, on the Wednesday night video. Like, look, what had we done this week? And the answer was absolutely nothing. Said prepare for volatility. And it's volatility we got on Thursday and Friday. Like, who would have thought we actually would tag the upper edge of the expected move? No rhyme, no reason, but a 60 handle rally literally comes, well, seemingly out of nowhere. We explode to the upside, and literally in the SPX, when I say that we tag the upper edge of the expected move, well, we're going to be talking extensively about this expected move throughout the course of this weekend update, because it's a lot of what's in play right now for this 0DTE. Now, before we made the rip and rally, I think a lot of people could probably argue, and we're going to cruise over to the S&P futures for a moment. A lot of people could probably argue that we were in dramatically oversold territory. And I don't think I can disagree with that notion. Like, look, the idea of overbought, oversold just has never done it for me. Like, I'm not a chart guy. I'm much more of a quantitative trader. Nevertheless, some pretty strong sell side activity. I mean, we basically, we came off roughly 4,200. We never looked back. It was straight down from 4,200. We literally tagged 39.31. For those of you who actually tune into the videos that we do on a week-to-week basis, last weekend, we literally said, hey, look for 39.31 to make its appearance. And an appearance, it did. And what did we do? We literally springboard a little higher off that. So whether you want to call it overbought, oversold, I could care less. All right. What I'd want to do is identify specific levels, right? So on your screen, marked on that screen right now, we have 39.31 to the upside over here. Okay. And when I say to the upside, all right, we've identified a number of key levels, what we term gravity points. The upper level that you're looking at right here, I'm going to mark it up on your screen. That one happens to be 4106. 4106. All right. So if we're going to have an upside target for the coming week, that would be it. Okay. And again, I can't stress this enough, is that when you're actually looking at these targets, like, they're stopping points along the way. So we come off the 39.31, we rip, possibly all the way into the 4106, and we'll actually take it from there. Nevertheless, coming back down to the 39.31, it's plausible, right? And you're going to have to realize you're coming into a week where, there's a lot going to happen, and I'll come to that in just a moment. Now, what actually is responsible for the rally inside of the S&Ps? And it's a pretty easy argument. From my point of view, it's right here. The ZB Okay, ZB, big bid under the ZB. And this is actually my point. If you were listening to the Wednesday night video, I go, look, if the bonds continue to break lower, markets are going to fall apart. And that's exactly what happened. The market did fall apart, fell all the way apart to 39.31. All of a sudden, the bonds, big bid comes under the bonds, stabilizes the entire market along with the dollar. I cannot stress enough that next week, right, you got to pay careful attention to this because the bonds out here, they are still in horrendous territory. And again, I really should contract adjust this. It drives me crazy to even look at it without it being contract adjusted, which ultimately makes it a continuous contract. But the bonds in horrendous territory. Like this is the first real bid we've seen under the bonds in, look, how many weeks? I mean, the last time we saw a bid back to back, you got to go all the way to the end of January. So it's been kind of Mr. Toad's wild ride right now in the bond market to the downside. The bid under the bonds stabilized the S&Ps. Okay. Along with that, well, the dollar kind of followed suit. As I said, the dollar actually saw a little bit of sell side activity. The dollar kind of feels maybe it's actually paused at the 105 level. But I got to tell you, okay, markets are being driven day to day. You know, and we can talk about DTE in a second, but markets are being driven day to day. Obviously, number one, by the 0 days to expiration trade that's going on. And number two, okay, every announcement that comes out, and I keep saying this, they're just catalysts. It's just every single, day when news gets dropped, data gets dropped, or Jerome Powell speaks, it's throwing a match into a pool of gasoline. So JPOW, yeah, he's going to speak next week. In fact, to give you a little bit of the calendar next week, it's not often I actually do this on a weekend update, but I got to tell you, there's a lot coming out next week. I mean, factory orders, a little of this, a little of that. So the factory orders, all right, I'll give you that. It might move markets a little bit, but the big one that, of course, everybody's going to be talking about throughout the course of the week is going to be, it's not the Bank of Canada. That much I promise you. It's not the Bank of Canada. It's actually going to be Jerome Powell. Okay, so Jerome Powell is actually going to have a speech. Okay, and part of that is going to be, this is it's a pretty broad topic of conversation, but I'll get right down to it. This is the CME FedWatch tool. And one thing that has been, I say, kind of the topic of conversation, the chance of the 50 basis point hike continues to go a little bit higher throughout the course of this week. And the reason I'm bringing it up, if the Fed is going to make a 50 basis point hike because they think inflation's coming back or inflation's not dead, you realize that also says we've made a massive policy mistake. That 25 basis point increase, the last Fed meeting was completely wrong. This time we got to hit the accelerator again, and it would be an absolute debacle. If that is going to be the case, the reason that this little speech could be important here is they would allude to that. And again, this is semi-annual monetary policy testimony, but this is something that could be alluded to by some of the Fed speak throughout the course of this next week. And of course, wrapping up the entire week, you're going to have the jobs number. So you want to hotbed a risk, you got one, right? So it's going to be a little bit wild again throughout the course of this week. And it's just, these matches being poured into a pool of gasoline. It's all kinds of fun. All right, onward and upward as the SPs are up some 60 handles. We're going to completely switch gears now, and we're going to talk about 0 DTE continues to move markets. All right, so why is it continuing to move markets? For those of you that understand a little bit about what we do here at TheoTrade, without having to go into too much and incredible detail, okay, what I really want to do over the next 5 to 10 minutes is just explain a little bit about what we term expected move, okay? Expected move, what expected move happens to be, we look out about 7 days, right? And if you come out here 7 days, if you take a look at this number, it says plus or minus roughly $78. Now, what that $78 is based on, what this expected move really kind of delineates, okay? It is a 1 standard deviation move. So it says we're supposed to move up $78 or down $78. Okay, and we're supposed to stay in that range about 68% of the time, yada, 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 okay? But it's good for the next week. So why? The big question is, why have we always looked, okay, at the 7 day? The 7 day, because it's 1 week, right? What was actually happening, and has happened for years, is on a Friday afternoon, like today, look, there's 10 minutes left to go. They would actually roll from one Friday. They would roll from like the March 3rd, boom, and they would roll right into the March 10th. Okay, and it made like that expected move by far and away, okay, the most, critical expected move. It still is the most critical expected move. But you're like, well, why? Why is it such a critical expected move? Because everything that transpires throughout the course of a given, trading week hinges on the idea that we're supposed to move $78. And you go, where's the $78 come from? It's not just some random equation. Okay, what the $78 really is based on, it's like an average. If you traded all the options inside this chain, okay, and when I say traded all the options inside the chain, and that really kind of freaks people out, but if you average the price of the options inside this chain together, whether you're a buyer, whether you're a seller, it comes out to somewhere near $78. What's cool about the expected move is it actually uses a little bit of skew in the equation, and it's like a blend, and it's a very accurate way of handicapping risk moving forward. And what people don't understand, though, about expected move is it's not just a fictitious number. There may be billions and billions of dollars traded on this number of $78. Well, what is actually happening right now with DTE, zero DTE, is that there is so much volume now brewing on a day-to-day basis. Like if you just look at today, well, it's a Friday and it's a little bit busier, whatever, but we're doing 2.6 million contracts inside of the SPX. What's crazy though? Most of those contracts, they're going off here in the zero DTE. Like, look at this. We opened the day with, there's 5,000 contracts over here. Yeah, well, there's 63,000 that have traded. Almost 100,000 have traded here. The volume far outweighs the open interest. That's because everybody's all of a sudden pushing volume, into the shortest duration possible. Now, the spiders are also seeing this. The spiders are seeing it in a magnificent fashion. Spiders are going to do clear into the 9 million contracts today. You realize that yesterday, the entire marketplace only traded 41 million contracts. Okay, of the 41 million contracts that traded, what? You have like 10 million that the spiders basically did yesterday. The SPX was good for over 2.5. So you're getting, anywhere from 12 to 14 million of 40 million contracts that are trading. I mean, you can say that, roughly speaking, almost a quarter of all the volume is coming out of the spiders or the SPX. But then you actually have to realize that the SPX is 10 times larger than even the spiders. So the SPX is basically, it's over half the notional value of the whole freaking market in options at this point is going through this product. And what's actually really transpiring inside of the SPX is when you start trading SPX options, you're going to move the S&P futures. The SPX, doesn't have an underlying. You can't buy it or sell it. And I'm actually clicking on it. Instrument is not tradable. You go, so how do you trade it? Well, you trade the options in the SPX, and then the hedge, the layoff for the risk comes in the S&P futures. So if you are, and again, I want to make this very, very clear so that everybody understands, if you're a retail trader, retail trader, you come in and you start buying all of these puts, right? So let's say you start buying, the 40 puts in here. So you start buying them. When you buy those puts, let me ask you something. Who sells you the put? Market maker does. Okay. So let's actually bring the trade up like on the chart over here. Just kind of blend it all together. Close that up a little bit over here. All right. So you went out and bought these puts. Doesn't matter what you paid for them. Okay, so the market maker, we'll call it the MM, goes out and sells puts. Now, when the market maker actually sells puts, they don't even care that they're the 40 40s. But if they go out and sell those puts, what it's actually doing is presenting a what? Positive delta to them because they sold puts. For those of you that don't understand delta, basically when you sell puts, you're like, where do you want the market to go? You want it to go up. That actually is equivalent to positive delta. Positive delta has to be offset as a market maker by negative delta. Why? Because market makers do not go unhedged in anything. So that negative delta, when I say negative delta, what they're actually doing to achieve negative delta, to offset any of the directional risk, market makers are not going to take any directional risk. To offset the directional risk, they're going to go out and they're going to sell, okay, ES futures contracts. You bought a put, you caused the market maker to sell futures contracts. Now, let's put this on an absolutely massive scale, okay? Can you imagine if a few million of these contracts are trading every single day? If a few million of these contracts are trading every single day, which they absolutely unequivocally are, what actually occurs, and I'm actually going to look at the 3-day expiration now, just to make it easier. What occurs, okay, is that this expected move, which expected move? This one. Now that, I know that this is for the Monday, We are now looking at Monday's expiration. Someone has a case of the Mondays. The reason we're looking at the Monday expiration, because the other one's about to go out in 5 minutes. But on the Monday expiration, okay, if everybody jumps in and starts trading it, okay, the average is going to be about 33 bucks. Okay, lo and behold, what you're going to start to see is markets that'll move up, for instance, $33. They'll move down at $33 and they'll literally pause at those particular levels. Why? Okay, because they're like critical hedge points for trade. And, I can get into the absolute details of this while I'm live on TheoTrade, of course, early next week. But I want you to understand, conceptually speaking, okay, conceptually speaking, all right, this is becoming more and more apparent, all right, okay, the more trade that we see actually generated into specifically the 0 DTE. So what you're actually getting, and it's kind of dangerous, is instead of just adhering to the weekly expected move, which we've paid attention to since 2017, like literally, if you took a look at the my SPX chart, and I opened up like a 10-year on here, starting in approximately 2017 timeframe, when they started adding, okay, multiple expirations, right? The very first week I did this was ironically in February of 2017. And we started actually tracking week to week expected moves. We know every time there's been a 3 sigma move and so forth. So why the cause for concern, okay? And I'm actually going to tell you exactly, first of all, okay, it's moving markets on a day-to-day basis. So you think to yourself, well, okay, so he's saying that we're not going to move but $32. No, most days you should move 32 bucks. You should, okay? But here's the really crazy part that people don't understand about 0 DTE. If you look at, okay, weekly expected moves, if a weekly expected move, let's say, for example, the expected move for the entire week is plus or minus $100, meaning that the market's supposed to move up 100 bucks or down 100 bucks, and that's what the option marketplace is handicapping it to move. Okay, could you move further than $100? Of course. Let's say we have a crazy week like this one where I highlighted it. Let's say the market moved down 200. If the market moves down 200, that's what we call 2 sigma move. And you go, oh, okay, so it's 2 sigma, okay, 2 sigma move. But, okay, if you look back, there's not too many 2 sigma moves. Here's like a 2 sigma move. Most of the breaches of expected move, yeah, there's some 2 sigma moves, nothing too wild. The most wild moves that you're going to see, and really anything in recent history, even in 2022, you'll see some 2 sigma moves and maybe 2.5, meaning that if the expected move for the entire week was $100, a 2.5 sigma move, we would have moved 250 bucks in the week. Want to know why DTE is so just so dangerous? Okay, if the expected move for the week is plus or minus, okay, again, I was saying for the week, but if it was for the week $100 and we moved 250, that would be something that would be spectacular. Now I want you to think of 0 DTE. What's the problem with 0 DTE? Well, if the expected move for the day is plus or minus, for instance, 30 bucks, okay? How often you've actually tuned into a screen and all of a sudden you see the market, for instance, move plus or minus $120. Can the market move 120 points? Of course it can. Can the expected move that day be 30 bucks and the market move 120 points? Of course it can. How many standard deviations is that? Oh yeah, that'd be like a 4 sigma move. What people don't understand about 0 days to expiration is it's a setup for an absolutely phenomenal move where people get ripped apart. If you're long the options, you're going to make a ton of money. If you're short the options, you get destroyed. The market making firms, they don't take a loss because they're actually hedging in real time. People have to understand is, okay, the 0 DTE is going to continue to move markets, right? And they're having multiple reversals on it. Again, I'll talk more about the reversals throughout the course of next week, but it's critical. Daily expected moves are becoming, right, like the in thing right now. And again, it's one of the reasons the option activity is actually moving the markets. The cart is leading the horse, people. And to understand this, okay, in all of its depth, it's causing intraday reversals, meaning we hit one of the edges of expected move, Okay, like down here, we rally back up. We hit an expected move, we sell back off, right? We come way down, we rally back up. You're seeing this again and again and again. Okay, there's the week. Okay, you're seeing it again and again though with intraday reversals. And I'm telling you right now, you can trade this stuff. You can absolutely trade this stuff. And okay, you want to be long options when there's 0 DTE, because once in a while you're going to get a 3 or 4 sigma move. You're going to hit a grand slam home run if you know what you're doing. All right. Moving on over here, get your trade on this week's profits and losses. This week was absolutely spectacular, okay? Two-sided trade. This is like, you can't ask for more than this. Started the week, went a little higher, we went dramatically lower, we actually exploded back onto the scene, okay? We closed all kinds of stuff. I covered a ton of stuff. I covered short calls, okay? If you want to see some of the short calls that I covered over here on Tasty. By the way, I'm trading more and more on Tasty Trade. In fact, most of the portfolios now that I'm running are actually on Tasty Trade, no longer so much on Thinkorswim. I just use some of the charts on Thinkorswim, but if you look at my activity, I closed some QQQ calls, okay? I actually closed puts on the micros. I closed puts on the S&P options on futures. I actually closed puts on the SPY, okay? It was a total free-for-all. Like every one of the trades that you're seeing right here, it's a 10 lot of calls, close 50%, just close 50%, close 50%, close 50%. Okay, this entire position over here, close 50% gains on all of them. Okay, close 50%, close 50%. In fact, this one just traded out, okay, just seconds ago as I was talking over here. So what do we have over here? Wildly profitable week. And that doesn't even begin to cover what we actually did in Catapults, because what we did in Catapult, for those of you that have no idea what Catapult happens to be, Catapult, and I'm actually going to come into a Catapult portfolio, right? Here, let's go into, this is only a $5,000 account. This is a Catapult small portfolio. What's so cool about this, I have on now no risk, but at the exact same time, I have an Intel spread, a QQQ, and a Tesla spread. They're all for free. Basically, what we're doing inside of Catapult, and the reason we call it Catapult, we're using, okay, S&P options on futures and selling the options on futures, covering them for 50% gains to finance the cost of spreads in Intel and QQQ and Tesla. And I've got a number of different portfolios that are doing exactly this. If you look at the trades in here, okay, all of these, like the inventory has been cleaned out. I closed this, and it actually left on some Apple, Goldman Sachs, QQQ, Starbucks. All those positions are basically free rides, okay? And when I say it's a free ride, that's it, people. It's a free ride from here. And some of those positions have 49, 50 days left to expiration. On top of it, I actually closed a Morgan Stanley in-out spread for a 55% gain. Again, it was a really strong week. The irony is the Morgan Stanley, that was a bearish trade. Okay, you see this huge bullish move that we had. Yeah, but that happened after some sell side activity, some buy side activity. All I ask people is some two-sided trade. All right, last thing we do each and every week here on the TheoTrade, again, weekend update. Well, I'll give you a quick update on the SPX expected move, exactly what we've been talking about. So we're still tracking weekly expected moves. And there's no question the weekly expected move still holds tremendous weight. There's no question about it. When I say it holds tremendous weight, like, look, we draw these, okay, every Friday afternoon. We're going to draw the expected move here. What? 15 minutes after the close. Look where we closed. It's a tag. We drew this last week, and like literally we closed on it. So if you have any question, like is the expected move effective and so forth, well, I don't know. There's a $4,000 product. Okay. The expected move that we drew was basically at 40.46. We missed it by less than 1 point. You tell me if it's effective. By the way, we didn't even miss it by 1 point because theoretically the S&P futures, they're still technically open and moving. Gotta love that, right? It is on the money. What are we looking at though for next week? Okay, one of the best ways to be able to handicap risk on a week-to-week basis, look at the expected move. Guess what? We just came off a week that had basically a $76 expected move. This next week, we're looking somewhere near a $78 expected move. So there's just a little bit more risk packed into this next week. Why? I don't know, maybe because of JPOW, testimony, okay? Maybe because some of the numbers are coming out, jobs numbers at the end of the week. I got to tell you, big rip and rally. But volatility, actually increased very slightly. Again, a big rip and rally, but volatility increased very slightly. And one thing that I want to reiterate about expected move, okay, and it goes hand in hand with understanding zero DTE. Day to day now, the markets are going to shift. It's not about where we're going to be, 2 or 3 weeks from now. Okay. You have to look at nothing more than key levels inside of the S&Ps. People, that's it, man. That's like what we have to go on over here. Up here, 42.11. Okay. Then we have that 41.06 to the downside. Okay. What do we have? 39.31. Look for us literally just to climb from one level to the other, pinging back and forth at this point. But as I said, the zero DTE, it basically rules the market along with these like catalysts that we're getting and data drops and Jerome Powell's, okay? It is a marketplace. As I said, it's like a fly. It's got a 7-second memory at this point. Recognize that. Sell longer duration premium. Hedge off the risk. And on a day-to-day basis, be on the buy side of options. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.